Hello everyone and welcome back to another Stock Unlock video. In today's video, we are going to be going over one of the key financial statements that companies put out on a quarterly and annual basis. And this one is the income statement. And this is one of the three key financial statements that businesses report to the public and to their investors. The other financial statements are the balance sheet and the cash flow statement, which we will also be going over in other videos. The income statement is incredibly important to understand and know how to read, and it's one of the key things that investors really pay attention to when they are analyzing a business and, well, trying to invest. In this video, we are going to be going over all things income statements. We're going to be looking at the key things that we need to know, some things to watch out for, the things that are good, and also some things that are bad. I think that it is really important to know how to spot red flags on an income statement, as well as how to spot the good things. That's why we're going to be going over both in today's video. And with that being said, let's just hop right into it. So the first thing that we got to say is how you get to the income statement is you head over to any company or stock that you want to take a look at on Stock Unlock, and then you click the Financials tab right here. And then all you have to do is click on the income statement subtab. Now, right away, if you are looking at all of these numbers and you have no idea what anything means, then what you can do is turn on Stock Unlock's education mode, and then all of these question marks will pop up literally all over the site. And then, for example, if you don't know what the cost of revenue is, you click on the question mark and Stock Unlock will explain to you what the cost of revenue is so that you can better understand all of the information that you are taking a look at. But for this video, I'm going to leave education mode off, but a lot of our users and our members really love education mode to help them learn more about investing. And we even have a lot of tips in our education mode. So if you're newer to investing, then again, make sure to turn on education mode. With that being said, we are going to be taking a look at Google or Alphabet. And what we can see right here on the income statement, right at the top line is the revenue. Now, the revenue that a business generates is like the amount of sales that it generates. And you can see this in either a quarterly view, which will tell you how much revenue the business is generating every single 3 months. You can do a trailing 12 months revenue, which will show you the last 12 months of the company's revenue, or you can do the yearly revenue, and that will show you the company's amount of revenue that it's generated in 2017, 18, 19, 2020, 2021, all the way back 20 years here on Stock Unlock. Now, in this video, we are going to be taking a look at the trailing 12 months because personally, that is my favorite thing to take a look at. Again, the top line on the income statement is the revenue. And when you're investing, you may hear people say, well, what is the company's top line? And the top line, well, the reason that they're saying that is because, again, the top line is the company's revenue. So if someone is saying top line, they're referring to the sales or the revenue that company generates. Now, the next line is the cost of revenue. And the cost of revenue is the cost associated with making the product or delivering the company's services. I like to think of the cost of revenue as like the business's necessary expenses to generate the revenue. And without these costs, the products or the services would not be delivered. So again, the cost of revenue is like the necessary expenses that the business has to pay. And then from the cost of revenue, you get the gross profit. And how the gross profit is figured out is you simply take the revenue, you subtract the cost of revenue, and that is the gross profit that the business generates. And then with the gross profits, what the business does is it pays its operating expenses and all of the other expenses that are associated with operating and growing the business. So that's why the next line here is the operating expenses. And this is broken down into things like research and development, which is how much money the company is spending on R&D or just, researching and developing new products. And then we have selling, general, and administrative expenses. This is like expenses with paying employees, paying salaries, running the business, growing the business. It's also sales and marketing expenses. And even stock-based compensation is baked into this number right here. So the operating expenses, again, are like expenses related to operating the business and growing the business. That leaves us with our total operating expenses, and the total operating expenses are subtracted from the gross profit to find the company's operating income or the company's operating loss if it is producing a loss on its operations. The operating income essentially tells investors if the operations of the business are generating money. This is like, if the operating income is negative, it means the company is losing money. And if the operating income is positive, then that means the company is generating a positive operating income and its operations are profitable. If we move down the income statement more, Then what is subtracted from the operating income is the net interest expense. What the net interest expense is the amount of interest that the company is paying on its debts or on its loans. If you see a very high net interest expense, then it could mean that the company has a lot of debt outstanding, and typically investors like to see the net interest expense be on the lower end, especially relative to the operating income. Then we have total other income and expenses. Then we have income before tax. So this is like the company's net income before it has to pay taxes. But, taxes are a very real expense that we all have to pay. You and I got to pay taxes, and businesses have to pay taxes as well. So from the income before tax, you then subtract the amount of tax that the company pays. And then finally, you have your net income, or the earnings that the company generated. So right here, we can see for Google, in the trailing 12 months, the company generated just about $75 billion in net income. And this is also known as the bottom line on the income statement. So if a company, or if you ever hear anyone talking about the bottom line is how much money that business actually produces in profits. It's how much money the business is actually generating and taking home. And it's essentially, again, just the earnings. Now, below the earnings, we have the diluted shares outstanding, which tells us how many shares are outstanding of that business. And typically, investors like to see the shares outstanding either remaining flat over time or going down. Because if a company is consistently increasing its shares outstanding, then it probably means that that business is doing some sort of dilution, or it's doing massive stock-based compensation and diluting their shareholders. And dilution takes away shareholder returns. It destroys shareholder value over the long term. So it's really important for investors to watch for how the diluted shares outstanding for the business is performing over time. Are they going down? Are they increasing dramatically? Then finally, we have the diluted EPS and EBITDA. EBITDA is the company's earnings before interest, taxes, depreciation, and amortization. A lot of people do not like to use EBITDA because it's the company's earnings, again, before interest, taxes, depreciation, and amortization, which are all real expenses for the business. So if you're looking at EBITDA, you're kind of looking at like the company's earnings before all of these other expenses, which is not like the company's true earnings, at least in my own opinion. That's like all of the key figures on the income statement, and you can really see how the income statement is meant to be read from top to bottom. You can see here that Google generated $270 billion in revenue in the trailing 12 months, but after paying the cost of revenue, the operating expenses, the interest expenses, and the taxes, the company was only left with about $75 billion of earnings. That's why, you really got to pay attention to like how much net income and earnings is the business producing, and not just the revenue. Because if the business has a ton of expenses, then it's not going to be able to generate a ton of cash and return that cash back to you as a shareholder. Yeah, again, those are some of the key, or that's just the metrics that you look at on the income statement. And now I want to show you guys some things that investors look for. I want to show you what some good things are. And this is why we use Google in all of our examples here on Stock Unlock, because it's just a fantastic business over the long term. When we're investing, or when an investor puts money into a business, the goal is to have that business grow and appreciate in value, and also grow the amount of cash that it can return back to you as a shareholder. On the income statement, you can take a look at if a business is growing by also clicking on the total revenue and seeing if the company's revenue and top line is growing over time. When we take a look at Google, this company's revenue grows fantastic over the long term, and it's just a business that continues growing and growing and growing. This is pretty much exactly what investors look for right here. Just consistent business growth and consistent revenue growth. Now, on top of that, what you want to see is the profits of all sorts growing for the business as well. So right here, we're taking a look at Google's gross profit, and we can see that Google's gross profit has been steadily increasing over the years as well. So the revenue is increasing, and that revenue increasing leads to gross profits increasing. If we look at the operating income, this is the exact same story. Over the long term, Google's operating income is growing, and it's actually been growing ridiculously well over the past couple of years. And then lastly, if we take a look at net income, we can see that net income has a little bit more dips. It's a little bit more volatile, but the overall trend for Google is its net income is increasing. So that's what investors really like to take a look at. They like to take a look at, is the revenue growing, gross profits growing, operating income growing, and net income growing? Is this business overall just expanding? Now, also, if we take a look at Google's shares outstanding on a yearly basis, We can see that in 2018, the company had about 703 million shares outstanding. And over the past couple of years, the shares have declined down to 678 million. This means that Google's shares outstanding over the past few years are coming down, which means that the company is buying back shares and returning cash back to the shareholders. That's typically what investors like to see. So those are the things that investors like to see on the income statement. And now let's head over to some things that investors do not like to see on the income statement, and myself included right here. So we're going to take a look at Beyond Meat. A lot of people know what Beyond Meat is. They do like fake meat and like plant-based meat. All right. Now, if we take a look at this company's total revenue, we can see that from 2017 to about 2019, the revenue was growing very well. So a lot of investors may like that. However, if we take a look at 2019 to today, about 3 years later, we can see that the revenue is kind of flatlining and not really growing anymore. What this ultimately tells me is that Beyond Meat is having a hard time growing its sales, growing its revenue, and ultimately growing its business. Keep this in mind, okay? The revenue is kind of flat. It's not really uptrending. It's not really growing. Now, take a look at the company's cost of that revenue. The cost of revenue is consistently growing and getting higher. So think about this. The revenue is pretty much flatlining, but the cost associated with producing that revenue is going up. And what this ultimately leads to is Beyond Meat's gross profits going down. And Beyond Meat's gross profits topped out in 2020, and in the most recent quarter, the company's gross profit almost went negative. When we factor in the company's just cost of revenue, now the gross profit is almost negative. And remember, companies use the gross profit to pay operating expenses, to pay taxes, pay interest, all those other expenses associated with the business. So if a company's gross profit is negative or about to go negative, then it essentially means that this business is incredibly unprofitable. And I personally do not like to see a trend where the company's gross profit is going down, because it means that it is becoming less and less profitable. And that's not a good thing as an investor, because when you're investing in a business, or investing in a stock, buying a stock, you are investing in that underlying business, its profit potential and its cash flow potential. So when I see the business like Beyond Meat getting less profitable over time, it kind of tells me that, it's not really, it may not be a strong long-term investment. Now, also take a look at the operating income on this business, because the operating income on just the last quarter was negative $95 million. So the operations, when we take the gross profit and we subtract the operating expenses, the operating income, just the operations of Beyond Meat, lost $95 million in 3 months. So this business is losing money and its losses are growing. It's not becoming more efficient, and it's costing more for this business just to sustain its revenue, because remember, the revenue isn't even growing. Like typically, if you see the expenses for a business growing like that, then what you want to see is the revenue growing with it, because maybe that business is investing a lot of money into growth. A lot of companies, when they're growing really quickly, they're not focused on profits. That's a fair argument. But when you see that the expenses are growing and the revenue isn't growing, that right there, my friends, is a massive, massive, massive red flag. So yeah, that's just something that you really want to take a look at. And I think that Beyond Meat is a great example of what you do not want to see. Now, another example that you really, really do not want to see that you can find on the income statement is by taking a look again at the company's diluted shares outstanding. So right now we're taking a look at a business called Hexo. This is a Canadian cannabis company. And back here in 2015, we can see that the company had about 7.3 million shares outstanding, okay? Now, in the most recent quarter, they had nearly 433 million shares outstanding. What this means is that over the past 7 years, what is this? This company has increased its share count by something like near 60x. I'm just doing that math off the top of my head. I don't know if that's correct, but that is a massive, 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 massive amount of dilution to the shareholders. And this absolutely destroys shareholder value. I'm going off topic right now, but if we take a look at Hexo's stock price, we can see that over just the past 2 years, the stock is down over 99%. And a large portion of that reason is because this company is doing so much dang dilution. And if we go over to the income statement, we can see that this company is generating no money. In the trailing 12 months, it lost $288 million on its operations. This company is losing money, and to stay in business, it has to dilute and raise money through dilution. And when you take a look at the income statement, that is very clear. And that is a massive red flag. When you're taking a look at the income statement, you definitely want to watch out for the shares outstanding, and if they are growing like 60x over 7 years, that's just way too much, guys. That is a massive, massive, massive red flag, and you can avoid some seriously bad investments by just taking a look at some of these key things on the income statement. Now, there is one final thing that we got to talk about, okay? And that is net income. So net income, again, is like the earnings that the business generates, right? It's the bottom line. It's supposed to show you the amount of profits that a business generates, but there's a caveat with net income. And net income, in my opinion, sometimes does not show you the true profit potential of a business. And you got to be aware of what net income actually is. To best explain net income, I took a screenshot from Warren Buffett's 2019 letter to Berkshire shareholders, and this basically explains exactly what you got to be aware of. So, for those of you who don't know, Warren Buffett is like the best investor of all time. He's a great guy, and basically whenever Warren Buffett says anything, almost the entire investing world listens because his returns over the past 60 years are unmatched. He is literally the best investor who's ever lived. And every single year, he does a letter to his shareholders to update them with his views on the market and investing principles. And again, in his 2019 letter, he writes this. This is a little bit of reading here. I'm going to read it to you. And trust me, it's worth your time. So, to the shareholders of Berkshire Hathaway, Berkshire earned $81.4 billion in 2019, according to generally accepted accounting principles, commonly called GAAP. The component of that figure are $24 billion of operating earnings, $3.7 billion of realized capital gains, and a $53.7 billion gain from an increase in the amount of net unrealized capital gains that exist in the stocks we hold. Each of those components of earnings is stated on an after-tax basis. That $53.7 billion gain requires comment. It resulted from a new GAAP rule imposed in 2018 that requires a company holding equity securities to include in earnings the net change in the unrealized gains and losses of those securities. As we stated in last year's letter, neither Charlie Munger, my partner in managing Berkshire, nor I agree with that rule. Essentially what this rule is if a company holds stocks in the market, then they have to start reporting their unrealized gains. So for example, if Berkshire Hathaway or Warren Buffett buys a stock and then that stock goes up massively, they have to report that as a gain even if they didn't sell the stock and they're just holding on to it. And then, so they report this massive gain in one quarter, and then let's say next quarter that stock doesn't perform well and the stock drops massively, okay? Well, now what the company has to do is report the loss from when the stock was high down to when the stock was low. They have to report that difference now as a loss in net income. Even though the entire time the company or Berkshire is not selling the stock, they're just holding on to it. And they plan to hold on to it for literally like the next 50 years. Basically what this means is that earnings now or net income now can be very, very, very volatile depending on what the unrealized losses and gains of their securities or of their assets are doing. So this can really skew a company's net income, and in my opinion, it can make it so that net income does not reflect the true profitability of a business anymore. But let's continue on to this bottom paragraph right here. And this says, Berkshire's 2018 and 2019 years glaringly illustrate the argument we have with the new rule. In 2018, a down year for the stock market, our net unrealized gains decreased by $20.6 billion. And we therefore reported GAAP earnings of only $4 billion. In 2019, rising stock prices increased net unrealized gains by the aforementioned $53.7 billion, pushing GAAP earnings up to $81.4 billion reported at the beginning of this letter. Those market gyrations led to a crazy 1,900% increase in GAAP earnings just year over year. Because the stock market was down in 2018, Berkshire Hathaway had to report a loss or had to report losses against net income. And then in 2019, when the stock market rebounded, they had an additional $53.7 billion in earnings that they accounted for, which led to a 19 times difference in earnings year over year. If we head over to Stock Unlock and we head over to Berkshire Hathaway's income statement, take a look at this. If we go to the yearly net income, we can see this right here. In 2018, the company reported $4 billion in net income, and then the next year it was $81.4 billion. take a look at the volatility of this net income and this earnings. And this is largely just led by whatever the stock market is doing. So again, in my opinion, this doesn't really accurately reflect the company's true profitability anymore. It isn't like this for all businesses, and some businesses are much more sensitive than others. I think Berkshire Hathaway is very sensitive to gyrations in the market like this. Not a lot of businesses are, or some businesses aren't that exposed, but you got to know that net income at some points with some businesses really does not reflect the company's true profitability anymore. And if we take a look at Berkshire's quarterly net income, I mean, take a look at this. In the fourth quarter of 2019, they reported $29 billion of earnings. And then in the first quarter, while the stock market was plunging, Berkshire Hathaway had to report negative $50 billion in earnings just because the stock market was down. This is a difference of $80 billion quarter over quarter in net income just because the stock market was up at the end of 2019 and then crashed in the first quarter of 2020. Again, I don't think that this really reflects the profitability of Berkshire's business. When you're taking a look at net income on the income statement and you see these gyrations like that, you just got to know that this is why. It's just unrealized reporting of losses or gains on assets held. And in my opinion, again, it doesn't truly reflect a business's profitability anymore. In my opinion, the cash flow statement now reflects the business's profitability much more accurately, and we will be doing a cash flow video here on the Stock Unlock channel, and I will be explaining to you why. But that's pretty much everything that you got to watch out for in the income statement. That's what everything means. Those are some of the key things that you can take away, and I really hope you enjoyed this video. If you did enjoy the video, then as always, please remember to leave a like on it. It really helps us grow this channel, and our entire mission here at Stock Unlock is to help you become a better investor. And these videos are just one way that we are trying to help everyone become better investors, myself included. So if you guys like Stock Unlock, if you guys want to come and try us out, you can get a 7-day free trial just by entering in your email over at stockunlock.com. We are continuing to build out this platform, and we are dedicated to helping you become a better investor. So yeah, check us out. I really hope you enjoy the platform, and I am sure that the team does as well. Thank you guys also for checking out this video and watching our video, and I really hope to see you all again in our next one.